The government just published January's inflation data showing a 3% annual increase. Wall Street analysts called it encouraging news. Meanwhile, your credit card statement tells a completely different story. I've been tracking institutional money flows for 15 years as an independent analyst. What I'm about to show you isn't some future prediction. It's a wealth extraction mechanism operating right now in plain sight. I'm Marcus Caldwell, and over the past 72 hours, I've analyzed the divergence between reported economic data and real household costs. What I found represents the largest hidden transfer of purchasing power in modern financial history. Let me show you the exact numbers. 3 years ago, your monthly household expenses totaled one specific amount. Today, for identical consumption patterns, you're paying 40% more. Housing costs up, insurance premiums up, utilities up, transportation up, medical expenses up. Yet the Consumer Price Index reports 3% annual inflation. This isn't measurement error. The CPI uses hedonic adjustments claiming products improve so higher prices don't count as inflation. It employs substitution effects assuming consumers will buy chicken when beef prices rise. It replaces actual housing costs with something called owner's equivalent rent. Each adjustment pushes the official number lower. That gap currently runs between 5 and 7 percentage points annually. Your purchasing power declines at 8 to 10% per year. Official statistics report 3%. That 5% differential represents an invisible tax extracted from every household in America. Your savings account pays 2% annual interest. Real inflation for household necessities runs at 9%. That's a 7% annual wealth destruction rate that never appears on any statement. Multiply that across tens of millions of households, compounded across multiple years. You're witnessing the most significant peacetime transfer of purchasing power ever recorded. And the design is brilliant because it's completely invisible. No tax bill arrives in your mailbox. Your account balance might even grow in nominal terms. But your ability to purchase a home, fund retirement, handle emergencies, educate children without crushing debt. All of that contracts systematically, while official numbers say everything remains stable. Before I reveal the specific mechanism driving this, if this analysis provides value, hit that subscribe button and activate notifications. This channel exists to deliver market intelligence that institutions deliberately obscure from retail investors. Your subscription directly supports independent financial research that prioritizes truth over narrative. Now let's examine exactly what the smart money understands about this dynamic. The Federal Reserve officially targets 2% inflation. That explicit goal means they're intentionally reducing your purchasing power by half every 35 years. But actual inflation for household necessities runs 3 to 4 times higher than their stated target. This creates impossible mathematics for anyone depending primarily on labor income. 1 generation ago, a single salary supported families, purchased homes, funded retirements, paid for education. Today, dual incomes barely achieve what single income previously provided. When housing consumes 50% of income instead of 25%, when healthcare costs triple relative to wage growth, when education requires debt taking decades to repay. Something fundamental broke in the exchange between work and economic reward. The system's response to this breakdown? Provide unlimited debt access. Can't afford housing? Here's a 30-year mortgage at elevated rates. Can't afford education? Here's a student loan with compounding interest. Can't afford transportation? Here's a 72-month payment plan. The solution to declining purchasing power is always more leverage. This creates the illusion of affordability while actually accelerating the wealth transfer mechanism. Let me break down the exact structure. The federal government carries $38 trillion in accumulated debt. Interest payments alone this fiscal year will exceed $1 trillion. That's approximately $3,000 per American citizen, including children, just to service borrowing created before most current taxpayers were born. The government cannot raise taxes sufficiently to cover spending without triggering economic collapse, cannot cut expenditures enough to balance budgets without triggering social instability, so it deploys the only remaining option: silent taxation through monetary debasement. Borrow aggressively, suppress interest rates below real inflation, devalue currency, reduce purchasing power. This functions as a hidden tax extracted every time citizens make purchases. Central banks manage this process deliberately. They need inflation low enough that populations don't recognize the theft, but high enough that government debt becomes manageable through devaluation. They need rates low enough that government can service debt obligations, but high enough that inflation doesn't spiral completely out of control. They're attempting to balance on a razor's edge, and that edge keeps getting sharper with each policy decision. Now here's where conventional market analysis gets everything backwards. Stock indexes hitting all-time highs while average households feel financially stressed isn't a paradox. It's the system functioning exactly as designed through this mechanism. When currency undergoes systematic debasement, when real returns on savings turn negative, when bonds pay less than inflation, capital must flow somewhere. It floods into equities, real estate, commodities, anything preserving value better than cash. The Shiller price-to-earnings ratio currently sits at 40. That's not just expensive markets. It's a quantifiable measure of capital desperation. The Buffett indicator stands at 225% of GDP. That's not irrational exuberance. That's rational response to irrational monetary policy creating forced asset allocation. Investors aren't buying stocks expecting robust earnings growth. They're buying stocks because holding cash guarantees purchasing power loss. This creates the cruelest aspect of the entire structure. The solution to currency debasement is owning productive assets. But acquiring meaningful asset positions requires capital. If you're operating paycheck to paycheck, struggling with rent, student loans, medical bills, you don't have capital to deploy. You're trapped earning currency that loses value while watching asset prices rise beyond reach. The wealth gap isn't widening because equity markets appreciate. Equity markets appreciate because wealth is being systematically pushed from currency into assets. Only those with existing capital can participate in this dynamic. Looking at January 2026, we can observe this playing out in real time across multiple markets. Equity indexes hover near record valuations. Bond yields remain elevated despite recession concerns. Credit spreads have widened significantly. These aren't contradictory signals. They're different manifestations of the same underlying dynamic. Assets price expensively because currency is being destroyed. Bonds yield more because debt levels have become unsustainable. Credit costs more because default risk is genuinely rising. The commercial real estate sector demonstrates this perfectly. Properties financed at 3% in 2021 now face refinancing at 6%, with valuations down 30%. That's what happens when you construct an entire asset class on the assumption that rates will stay artificially suppressed indefinitely. Then discover that assumption was false. The pain isn't arriving in some future crisis. The pain is happening right now. Consumer debt tells an identical story from a different angle. Auto loans total $1.66 trillion, with average monthly payments of $748. Delinquency rates hit 6.65%, the highest level in 3 decades. Nearly 1.73 million repossessions occurred last year. Credit card debt exceeds $1.1 trillion with interest rates above 20%. When auto loan delinquencies reach 30-year highs, it signals something specific. Vehicles are typically the last payment people default on because transportation is essential for employment. Mass delinquencies mean consumers have exhausted every other option. And 28% of vehicle trade-ins are underwater, with owners owing an average of $6,900 more than their cars are worth. This means there's no escape route. But here's what makes this different from traditional financial crises. In 2008, the problem was excessive leverage concentrated in housing. The solution was bailouts, stimulus programs, and zero interest rates. The system could respond because government debt was manageable and inflation was dormant. Today, government debt is catastrophic, and inflation remains persistent. The tools that worked previously don't work now. The central bank cannot cut rates to zero without reigniting inflation. The government cannot spend trillions more without triggering a sovereign debt crisis. We're systematically trapped by the accumulated consequences of previous policy decisions. Everyone searches for the moment of collapse, the Lehman Brothers event, the Black Monday crash. But what's happening now is fundamentally different. This is gradual erosion, grinding decline, purchasing power degrading year after year. Asset prices remain elevated or even increase, creating the illusion of prosperity, while actual living standards deteriorate systematically. In Argentina, stock markets rose in nominal terms while the country descended into economic chaos. In Turkey, real estate prices soared in lira terms while ordinary citizens became impoverished. In both cases, assets appreciated because currency collapsed. That's financial repression in action. That's what systemic breakdown looks like when it happens gradually instead of suddenly. The Western world is experiencing a gentler version of this identical dynamic. Currency debasement occurs at 8 to 10% annually instead of 50 or 100%. But for those without assets, for those living on labor income exclusively, purchasing power evaporates steadily. You're not getting poorer because you made poor decisions. You're getting poorer because the system is deliberately designed to extract wealth from labor and transfer it to capital. Demographics have fundamentally broken the social contract modern economies were constructed upon. Aging populations with massive entitlement promises funded by shrinking working-age populations. The ratio of workers to retirees keeps falling. Social Security, Medicare, pension systems, all designed assuming demographics that no longer exist. 5 workers supporting 1 retiree creates manageable burden. 2 workers supporting 1 retiree creates crushing burden. We're heading toward ratios approaching 1-to-1 in some developed countries. This demographic reality guarantees continued financial repression. The only option is devaluing the promises through inflation while maintaining nominal payments. You'll receive your Social Security check. It just won't purchase what you anticipated. Make sure you're subscribed, because what's coming will separate those who understand this dynamic from those who get crushed by it. Education costs increased 1,200% since 1980, while wages barely doubled. Students graduate with $50,000 to $200,000 in debt. They're starting adult life underwater, and the mathematics never improve from there. What about GDP growth? Doesn't rising GDP indicate economic health? GDP measures total output without measuring distribution. An economy where one person makes $1 billion and everyone else makes nothing shows GDP growth. GDP can grow, while median household purchasing power declines. GDP can grow while homeownership becomes impossible for younger generations. When governments manipulate currency and statistics to create the appearance of growth, GDP becomes meaningless as a prosperity measure. What should you actually do with this intelligence? First, understand you're not experiencing individual failure. If you feel like you're working harder for less, you're correct. The system is gaslighting you with statistics that don't reflect actual experience. Trust your lived reality over official data. Second, recognize that holding cash represents a guaranteed losing position. Emergency savings are necessary and prudent, but long-term wealth must exist in assets that preserve value through currency debasement. For most people, that means combinations of real estate despite elevated prices, equities, despite stretched valuations, or commodities. The alternatives, cash and bonds at negative real yields, guarantee poverty. Third, understand debt is a trap disguised as a solution. Every dollar borrowed is a claim against your future income. When wages don't keep pace with inflation, debt becomes an anchor drowning you. Minimize it aggressively. Fourth, invest in skills that have genuine market value independent of credentials. Skills solving actual problems, creating tangible value, those transfer across economic systems. Fifth, build community and relationships deliberately. When systems break down, the networks you've built become your most valuable asset. Sixth, Track what your expenses actually do, not what the government claims inflation is. Monitor your grocery bill, rent, insurance, utilities. If those costs rise 8 to 10% annually, you need income or investment returns exceeding that rate just to maintain position. Your personal inflation rate is what matters. The system will not save you. It cannot. The mathematics are broken beyond repair without consequences no politician will accept. Currency debasement will continue because it's the only politically feasible option. Asset prices will remain elevated or go higher because capital has nowhere else to deploy. But here's what provides hope. Once you understand the mechanism, you can position yourself accordingly. You can't fix the system, but you can refuse to be its victim. You can hold assets instead of currency. You can avoid debt traps. You can invest in skills and relationships. This isn't about fear. It's about clarity. Fear paralyzes. Clarity empowers. The system is designed to keep you confused, focused on short-term noise, while long-term trends destroy your wealth. Breaking through that confusion, seeing the mechanism clearly, that's the first step toward protecting yourself and your family. Your rent payment doesn't lie. Your grocery bill doesn't lie. Your insurance premium doesn't lie. When those costs consume ever larger shares of your income while authorities claim inflation is modest, believe your expenses, not their numbers. The silent wealth transfer is happening right now. Every month you hold cash, losing 6 to 8% purchasing power annually. Every year you watch asset prices rise beyond reach while earning wages that don't keep pace. This isn't a future crisis. This is present reality. The system needs you compliant and confused. Breaking free starts with seeing clearly. And once you see, you can't unsee. The choice becomes simple. Adapt or decline. Position yourself or become collateral damage. There's no third option.